we're building new DeFi protocols that have never existed before ever in the space that actually not only competes against CeFi in significant ways, but it can do it faster, cheaper, and more effectively with full transparency.
Alrighty, everyone. Welcome back to another episode of 0x Research. This show is presented by our incredible sponsors, Chainalysis and Flipside. Today is December 19th, and we've got a great interview coming at you with Chad Barraford, one of the developers of THORChain. In light of all the recent centralized exchange drama, it's a great conversation around the importance of cross-chain decentralized exchanges. We really get into like the details of what THORChain is, how it works on the protocol level. Tried to poke at some of like the more risky side of the protocol as well, and Chad had some great responses of kind of like what they're building and why they're building it. But before we get into that interview, we're joined today by 0x Pibbles and Westies from the Blockworks research team to discuss the latest market happenings. There's definitely a lot to unpack with this week and kind of just the past couple months in crypto as a whole. But we can dive right into things. Sam, you want to kick us off? Who do you got in the hot seat this week?
Yeah, the hot seat's pretty easy this week. We've got basically DCG and Barry Silbert. He finally kind of broke his silence earlier today on Twitter, and we're recording on the 19th of December, just for the listeners in case this goes a little bit stale by the time it publishes on Wednesday. But he tweeted that there's a potential tender offer that they might be engaging in order to try and basically decrease the discount that GBTC trades to NAV by offering to buy back some of the shares on the open market. I think it's up to 20% with capital in order to try and kind of provide more value to shareholders, because last time I checked, it's trading at about a 48% discount to NAV. So this would be a way to kind of even out that spread. My one question is just if DCG is in a liquidity crunch. I don't understand how they have the spare capital to actually repurchase those shares from shareholders at a predetermined price for a specified window of time. To me, I've been seeing a lot of stuff on Twitter about maybe they liquidate some of their Bitcoin or ETH holdings outside of the actual trust, because it's not clear if they could liquidate parts of it in order to raise capital. So yeah, that's an easy hot seat. We're all still watching that one pretty closely. Not really sure how it's going to play out, but definitely got the hot seat for the week.
Yeah, welcome back, Barry Silbert, on this one. It was the silence was deafening from him, and I guess this is kind of ultimately the direction it seemed like it was going. It's not great. It's not terrible. It's maybe somewhere in the middle. We're kind of really yet to be seen at what the true market impact of this will be. But this kind of feels like the last domino. And of course, I feel terrible saying that. It's the classic, how much worse can it really get? But, I feel like we're like a couple months out from actually having the bottom in terms of what can go wrong. So it's good to get, some of these final resolutions getting closer.
Here's some speculation on where that money's coming from to buy it back. If you look at the Berry coins and you chart those, you've got like Filecoin, Near, Mana, or is it Sand? One of those. They are all down horrifically this past week. So that's definitely where some of the money's coming from. They're scrambling for cash.
Yeah, I actually saw those charts. I think it was on Friday night that he dumped those too. Like everyone going into the weekend, literally no trading volume. So that's a good theory there, Pibbles. I didn't really even consider that at all. I had already forgotten about it over the weekend. But yeah, not much else to say on that front, considering the situation's still unfolding. So Westy, I'll pass it over to you so you can give your hot seat for the week.
Yeah, definitely. My hot seat, I have Rune, which is a pretty popular wrapped asset protocol. And so their main asset is Rune BTC, allowing you to use essentially Bitcoin's price action on Ethereum. And they announced, I don't know if it was a week ago, pretty recently, that they were going to shut down their mainnet. And this sort of caused a couple issues. First is around, obviously, the Rune assets. I think there's still $15 million in assets outstanding for Rune. And so this is assets once they shut down. I think it's on Tuesday this week. That's assets that are essentially going to go to zero. And so users are basically encouraged to bridge their assets back to the primary chain that they're on and get their value back. But it's also bad for its implications on curve pools. I know Rune BTC was used in a lot of different sort of wrapped asset pools within Curve. And this also brings up the question, can wrapped assets work in the long term? Or do we need to go with something like THORChain where it's essentially native to native bridging from one chain to the other with actual native assets as opposed to wrapped assets. So I'm wondering, yeah, what do you guys think about this Ren situation?
Yeah, they Ren kind of got punched in the mouth in the FTX Alameda washout. I think it was a couple earlier in the year. I want to say it was around like the end of Q4 of last year. They had a partnership with Alameda, and Alameda actually acquired Ren, and to kind of like prolong the funding for the protocol. And of course, with Alameda filing for Chapter 11 bankruptcy, that kind of all fell to the wayside, and now the Ren protocol and the Ren team kind of found themselves like being unable to continue the building of this. And so I think their game plan really was to close up shop on Ren 1.0, focus on Ren 2.0, and then of course the issue that arises is there's no like. They said they came out and said, we can't guarantee compatibility between Ren 1.0 and Ren 2.0. So, of course, like 1.0 assets wouldn't be able to be transferred over to 2.0. Basically putting this like pressure on anybody holding, Ren BTC, which is their largest holding, or any of their other wrapped assets. And it's really just like, it's been a constant theme throughout the entire year that wrapped assets are not real assets. This first really got shoved into the mainstream when we saw the wormhole hack, when it was like millions and millions of dollars of wrapped ETH on Solana became like worthless, and of course Jump plugged that hole. And it's like we always just like need someone to keep plugging these wrapped asset holes, which is ironic that this episode is going to be an interview with THORChain, which is essentially a bridge that gets like only deals in native assets, doesn't wrap assets. If you swap a Bitcoin for ETH, then you give native Bitcoin, you receive native ETH, and the assets stay on both of their respective chains. And it really just highlights like that's just clearly a better way to be pushing towards, and it just has a different security model that it would need to kind of facilitate these things. But wrapped assets just really, those kind of need to die in this bull run and bear market.
So I think another issue that arises from this, and this is more applying to crypto as a whole, is if you're someone who just like saw Ren Bitcoin and like maybe this was a year ago and you're like, nice, that's Bitcoin on Ethereum, I can get yield on that. And they like, so you buy Ren Bitcoin, maybe you're LPing on Curve or something. What if you're just like not around your computer this month? Like what if you like took a little sabbatical, you're off in like the Himalayas or something? Like crypto as an asset class, there are like so many things that you really can't set and forget. Like someone who doesn't follow them on Twitter is not going to see that, all this Bitcoin is just about to disappear. And I think it raises like a broader topic for the entire ecosystem. Still needs to be solved.
Yeah, strong agree with you there. It's like, like going into this bull run with all the mania around it, all my friends are like, what do I buy? And, I try to like give my best suggestions at the time. That's never happening again. My answer is officially nothing. Stay away from it. If you don't pay attention to it every day, it's not worth your time. Like, to your point, Spencer, you can't set it and forget it. And like, that's such the mentality with like investing in stocks and equities is like, buy an ETF, worry about it when you're getting ready to retire, and like just for like essentially forget you own it. And to your point, that just can't be done here. It just really changes my perspective on how I answer that question.
Yeah, and with all the bridge hacks we saw over 2022, and then you can 10x that number, which is probably like 2 billion, and you still don't even get to the number of centralized custodians. So you either have this, fluid situation you got to constantly pay attention to, or you have a centralized entity like custodying it for you, which we see also doesn't work. So yeah, stay clear of wrapped assets would be my best advice. But Pibbles, I know you got a cool throne for the week. You wanna toss it over to you for that?
Yeah, so we're looking at BitDAO. They put up a governance proposal yesterday, and they want to start buying $2 million worth of BIT token for 50 days starting on January 1st. So this adds up to be like $100 million of a buyback, and I think they have like a 300 mil circulating supply. So I think it's going to be really interesting to see if this does anything for the price of the BIT token. And I also just think it'll be a nice experiment in seeing how buybacks work, because they don't always lead to sustainable price action. It is also just an ultimate cool throne because BitDAO's sitting there with $1.7 billion in their treasury, and they're like, we'll just buy our token back. It's fine.
What is that $1.7 billion held in? Is it mostly like other tokens like USDC or ETH?
It's a good question. Let's see if I can find it.
I actually just wrote a report on this, so I know it off the top of my head. It's like 425 million of stables and 350 million of ETH, and then the rest is Bit. So they diversified really well, but all of that came from Bybit, which is, I believe, a Singaporean-based exchange. And they were redirecting 2.5 bips of all futures volume over to their treasury, paid out in ETH and USDC and USDT. So yeah, I mean, they are the only DAO who has that big of a revenue stream, but then those were redirected to Bit burns. So it's kind of a fluid situation. And what Pibble's brought up is kind of the next iteration of the buyback program. So I agree. I think it's an interesting one to pay attention to, especially with their modular L2 launching on testnet in Q1 of next year. So I could for sure see something, positive going for the Bit token price. But at the same time, I'm a little bit wary of centralized exchanges doing weird things with tokens that they're closely affiliated with for pretty obvious reasons. So it's also one I really don't want to touch, but one I'm watching out for.
So they're buying Bit back, they're burning Bit, they're generating income from an exchange. They got 700 million in non-native token holdings. I mean, that's kind of juicy.
It's pretty funny to see sort of opposites within DeFi protocols. So you have Bit that's just buying $100 million of the token, and then on the other end you have Sushi that's just absolutely strapped for cash, like just cut half of their developer costs and are redirecting all of the revenue back to the treasury. It's just, completely opposite situations, which is interesting to see in such a bad bear market.
Yeah, there's irony in that too, because Bit launched and tried to do a treasury swap with Sushi, and the tokens are still sitting there in that contract. Like, it's like they never even really claimed them, and I couldn't find any traces of X Sushi or Sushi in the BitDAO treasury wallet. So I don't even know what happened with that, but it's funny that we're seeing these problems with Sushi Swap and BitDAO sitting over here like, let's buy back $100 million worth of our token on secondary. Dan, do you have a cool throne for us for the week?
Yeah, I got the Trump NFT dumpers. They got a nice little run up there. I think they're a $100 starting price, so call 0.1 ETH. Ran up just shy of 1 ETH, so almost pulled a 10x on it. Last I checked, it was around the 0.55 range. So I had a nice little pullback, but still up, 5x from mint price. And it's pretty funny. Blockworks Research put out a thread on this. I think, Sam, you were the one who authored this one, and it kind of just highlighted what all went down with the NFT. And Trump's like a 78-year-old dude. He probably had very little to actually do at this launch, but it's pretty funny to just kind of see, it was a pretty poorly executed NFT launch. They used stock images that are like 1-for-1 rips from like Walmart and Amazon websites, and it's just pretty funny to see like the poor execution and even some insider flows happening. They minted like 100 or was it 1,000 of their own NFTs back to the creator wallet. So maybe trying to profit off their own mint, but it is pretty interesting just kind of see how this all plays out. And like when celebrities get NFTs tied to their name, the immediate reaction is like, oh, like this celebrity did this. In this case, Trump did this, and it's like, okay, yes, they signed off on it, but Trump is not out here coding smart contracts. So it's just kind of funny to see some negative backlash get directed to the person, which is probably still rightful. If a high-profile celebrity is going to be doing things like this, they need to be doing their due diligence just like anybody else. But yeah, this was the latest NFT pump. So if you were on the selling side, congratulations.
I think it's a good sign when we're sort of at peak boredom in the market that all of a sudden we have an NFT launch that people are excited about, even though I certainly wasn't expecting people to actually be buying this NFT, but the fact that we got a little bit of a pump and some excitement around it, it just makes me a lot more optimistic. And that really, in the next 3 to 6 months, even if we get Cyber's price action on Bitcoin and ETH, that there very well could be a big game launch, big NFT launch that actually does generate excitement, even in the broader bear market. So it was just good to see something go off when everything else is pretty pretty sideways or down.
Yeah, strong agree there. Good sign. And of course, they launched that NFT collection on Polygon, I'm pretty sure. So yet another win for the Polygon BD team, getting Trump on that on that network. So never surprises me.
Yeah, no kidding. Long live Polygon BD. And yeah, we can probably jump into some of our Flipside Dash this week. And as always, shout out to Flipside. They really do have the best on-chain data. And in a time where it's becoming increasingly more important, that data is free. It's super exciting to see them doing things like this. Like, I'm a huge fan of the data they're curating. They have like 17 chains now. And doing a really good job of curating data in the Cosmos ecosystem. So speaking of which, we got THORChain in the interview this week, and they have THORChain data. They do a great job of bringing in and curating that data. Their tables are very up to date as well. So looking at some Ethereum data today, if I share my screen here, you might notice this is not a dashboard and a little bit of a different looking UI. Flipside is kind of rolling out a beta UI to kind of give more of like a developer feel to their web environment, coding environment, and a huge fan of it so far. And they're doing a good job like working out the kinks in real time. So if you are messing around in this, be aware it's a beta. I think they're trying to launch the full product in the beginning of 23, so just around the corner. But if you look here, we have a chart that is comparing the average volume share of Ethereum DEXs between Curve and Uniswap. Apologies for the colors here for the listener or for the watchers rather than the listeners. But what we're looking at is just an average volume share, and I smoothed it over a 30-day moving average just to kind of remove some of that volatility in the data. Curve has a 10 to 25% volume share of the combined volume between the two DEXs. And what you notice is, it's been pretty consistent on the lower end of that scale, and there's been a couple of jumps, and most recently is this latest move up towards 27%. And this is kind of something the analyst team jokes about or discusses quite a bit. Is like, okay, Uniswap is by far the dominant DEX. It's been the ringleader for quite some time. Will it continue that dominance going forward? And as somebody who's like really interested in Curve and what they're doing and kind of building out the design space of a token and using they have the best executed vote escrow model without a doubt. Convex sits on top of them and plays a huge role in their ecosystem. And love or hate VE tokenomics, that's definitely so there's two strong camps there. Curve has successfully pulled it off to this point in time, and it's interesting to see that they're kind of starting to claw away some of this market share. I'm curious if any of you guys have a take on, will Uniswap remain the dominant DEX, or will we see some sort of like a transition when we move forward into 2023 and beyond?
I think the answer is really whoever develops a centralized order book built on top of a DEX, I think that's who wins the volume. And I know Uniswap funded one team to do that with a grant. So if they get that done, then maybe they keep that dominance. But if not, I'm going to go where the incentives are. And if I have no incentive to use Uni or provide liquidity on Uni, then I'm not sticking around. I don't even use Uniswap now directly. I just use like an aggregator. So tomatoes for me.
I think that last point's a great point though, right? Like, whoever throws the best price is ultimately where people will get routed to. And, the classic argument is, yeah, but Uniswap has such a dominant brand name. And yes, it does to this generation of users. But when we onboard another million users, I personally find it hard to believe that they're going to have that same feeling. Now that crypto has become a lot more usable, like DeFi today is much different than DeFi 2 years ago. And while it's still feels a little sketchy sending some transactions here or there, it's come a long way in terms of UI UX. So I personally don't think that brand value is gonna you have to think about how you're gonna capture the next wave of users, because we're still at such a fraction. There's maybe on the order of 10 million people that are actually using DeFi today.
Yeah, I guess the one thing that would make me think maybe they can keep the ball rolling is obviously their lead that they have right now, but then the fee switch discussion, if that does go back to, token stakers or whatever model they implement to kind of redistribute that revenue back to token holders, I could just see whales accumulating Uni, being active in governance, and then placing all their trades there because they'd be making a percentage of what they're paying back through whatever revenue generation model it is. So that's the one bull case I see, but I agree. I mean, there's better options out there. Why not use an aggregator at the end of the day?
I personally think the one that wins is who best navigates the roll-up centric future of ETH. And like Pibbles said, I think it's going to look more like a central limit order book than like an AMM. And so, yeah, I think there's a lot more time to go. I definitely don't think, even with Uniswap's market share now, that it's game over. But yeah, that's how I'm thinking about it.
Yeah, I think one of the bigger turning points could be like Uniswap has really missed the boat on the transaction volume for liquid staking derivatives, right? So staked ETH is by far the most dominant liquid staking derivative, and all of it that finds all of its liquidity on Curve instead of Uniswap. And so, I think maybe I don't want to speak for anyone, but I think we're all kind of in agreement that liquid staking protocols are going to be a massive industry going forward, and the UI UX of using LSDs is just such an advantage. And relative to having to run your own validator or anything like that. So I think that's kind of going to be the bull case for other dexes instead of Uniswap is, that's where a lot of those other dexes are where this transaction volume is occurring for these staking derivatives. And as that sector continues to grow, so will those transaction volumes, and ultimately so will the fees paid on those transaction volumes, and so will the protocol revenue of other dexes relative to Uniswap. So that's kind of my bull case for other dexes. But I want to give another shout out to Flipside for really having the best data and making this type of analysis possible. Be sure to check out the show notes if you're somebody who likes to, kind of analyze blockchain data and has some SQL skills. Then we got a little challenge for you to go through a bounty, and you can earn some free USDC for doing so.
Yeah, I'd like to take a second too to just thank our other wonderful sponsor, Chainalysis. They're providing all the analytics tools that our industry really needs in order to help legitimize our industry and provide the tools for professional investors to get active in the space. They also offer some great research in the space, which is available for free on their website. So I'd highly recommend checking that out if you want to learn more. And they also have some great courses on all things crypto, very niche topics. If you want to get really into the weeds, I highly recommend checking out Chainalysis for that kind of coursework that can help further your knowledge on the industry. We'll leave all that stuff in the show notes, so be sure to check them out.
Sweet. Well, without further ado, let's get straight into the interview with Chad Barraford from THORChain.
All right, everybody. We're here with Chad Barraford, lead developer of the THORChain community. Thanks for coming on, Chad.
Thanks for having me.
Yeah. So I guess we'll just get right into it. I think it'd be really helpful if you could kind of explain to the listener how THORChain differs from other bridge designs and kind of like the differences between the different design trade-offs.
Yeah, I mean, for one, I don't really consider THORChain to be a bridge. I guess some might see it that way, and that's a reasonable position to take, I suppose. But when I think about bridges, I think about services that will wrap an asset and then move the asset to another chain, like WBTC would be a wrapped asset. That's a bridge. You're taking a layer one asset like Bitcoin, and then you're moving it to Ethereum, and then that gets sent around Ethereum's world, doing whatever it does. In THORChain's case, it doesn't really do wrapped assets or anything like this. It just transfers value rather than assets. And so you're basically selling your Bitcoin and you're buying Ethereum, right? So that's why I don't consider it to be like a bridge, because like a centralized exchange does this all the time. I don't think anybody would consider Binance to be a bridge, although I guess you could make the argument, but nobody thinks of it that way. So like really more so, THORChain is more of a centralized exchange that's decentralized rather than being a bridge just trying to gap two chains with creating wrapped Bitcoin on some other chain.
Yeah, that makes a lot of sense. So I guess you're kind of like the decentralized alternative to a centralized exchange. And that kind of begs the question of, with all the drama we've seen with FTX, with BlockFi and different earn products. I know you guys just launched Savers Vaults.
Yep.
Could you kind of shed some light on what you think about the FTX situation and how it's potentially benefited THORChain and how it will over the long term?
Well, it saddens me in some sense that it benefits THORChain. I mean, I don't want to see people lose their money just so it makes it more obvious and clear why something like THORChain is valuable. Like I'd prefer people don't lose $10 billion of their money. Like that's obviously awful. But yeah, I mean, like the problem with the CeFi or centralized exchanges in general is that you always are exposed to the human risk, right? And humans are, they're irrational, they're corrupt, they're incompetent, they're And you never remove that. Never. It doesn't matter what you do, how many regulations you throw into the mix. There's always the human risk, right? People just doing terrible shit. And FTX is just the latest, proof of that in a very large scale way. Like it's shown in a way that was just like gargantuanly huge of how awful people can be and just burn other people's money to the ground. It's just terrible. But on the upside, I think one of the things that THORChain is doing as a project is that a lot of the services that we would see CeFi own, right? Like interest on your Bitcoin or Bitcoin loans or cross-chain swaps. A lot of these services were like the only place you could get them was through centralized services. And THORChain is a very unique protocol. It's the only one trying to actually compete against centralized exchanges in a meaningful way, and centralized institutions like BlockFi and these kind of services as well. And so we are as a project, as a community, we're building new DeFi protocols that have never existed before ever in the space that actually not only competes against CeFi in significant ways, but it can do it faster, cheaper, and more effectively with full transparency. Oh, by the way, and no borders as well. We don't really care if you're an American citizen or not, right? So that's structurally what we're doing as a community, and I wish more people were kind of fighting this battle with us, but I understand why. It's a very difficult and ambitious goal. So it's not easy. It's not an easy task by any stretch of the imagination, but it is something that needs to be done.
Yeah, absolutely. And you see centralized exchanges adding support for various assets relatively quickly. Is there any challenges, that arise trying to do this in a decentralized manner versus trying to do it as a centralized entity?
I think we're actually much more effective in that way than CeFi ever could be, because THORChain is this concept called what we call DEX aggregation, right? And it's this really fascinating notion that multiple DEXs of multiple ecosystems can use THORChain as a corridor to connect to each other. And so every DEX has access to the assets and the liquidity of every other DEX in the crypto space itself. And so the idea that you can go to any DEX and get access to Bitcoin, get access to Ethereum, get access to some long tail assets on AVAX or Cosmos or whatever, Cardano theoretically, anything, right? And that doesn't need to be adopted by THORChain directly. It just becomes a corridor to get from point A to point B. And so when you get to this place where every DEX has access to all assets across all chains, well, then how does CeFi compete with that? How is CeFi going to launch all these individual tokens, which is very expensive for them to do, right? That takes a lot of money, takes a lot of time, a lot of vetting. It's talking about hundreds of thousands of dollars of cost per token that a CeFi has to spend to do that. And in our case, people can just create the pool on Uniswap, for example, and then all of a sudden you have access from that token to every other token in the space. That's incredible. That's a game-changing concept that we are actually heading to, and THORChain's literally plowing that way.
Yeah, and it's pretty impossible not to be excited about the prospect of having a true centralized exchange experience, but decentralized. And so that kind of begs the question of all right, well, if you're going to do this, there has to be sound economic and security guarantees within the protocol. So I want to kind of dive in on that side. And you guys kind of have a pretty novel proof of bond consensus mechanism. So I'd love to get a little bit on that and kind of touch on, what the nodes are doing, securing the vaults, and just for the listener, the way that THORChain operates is it allows cross-chain swaps where the node operators kind of control these vaults, which are really just wallets on the various chains. And so, I'd like to talk a little bit about how that actually gets secured.
Yeah. So so THORChain has its own token called Rune, and it actually is one of the best cases of why you actually need a separate token, a new token, right? So in order to ensure economic security and that all the non-Rune or the non-native assets that the THORChain are secure, people need to put up a bond of this Rune token. And that Rune token needs the ability to go to zero. Actually, if the event were to occur where all the assets were stolen, all the Bitcoin, the Ethereum, the Doge, the Litecoin, all the AVAX, whatever, was stolen, then that point the Rune token would go to zero, which is actually a really important component for economic security, because it will always cost a lot more money to buy the Rune than to just burn it to zero and then acquire, far less quantity of Bitcoin and Ethereum and Doge and whatever tokens are on the network, right? And so like, this is the only project that I'm aware of that actually has economic security of external assets, right? Everybody else in the space just basically like shrugs their shoulders and like, oh yeah, like the value of the pools can be far greater than the value of the bond. In which case, if somebody just bought enough bond and then got a majority of the nodes and then stole all the Bitcoin or all the like whatever the assets were going to be, that are far more valuable than the money they spent to get to have that bond. It's just like, well, you've literally created an economic incentive to attack your network that there's nothing you can do about it. That's not a good idea. Like we just recently saw with FTX, according like they took like a $1.5 billion like loan to attack Terra. Accordingly, this is the rumor people are putting around. But like there are people with big wallets, massive whales who have the time and the energy and the effort and the will to do something if it's highly profitable for them. And so this is why economic security is so important. Like we can't just assume there's nobody rich who doesn't want to make more money. that's not a bet that I would personally want to take, And so we need economic security to say like, oh, if you're super mega rich, you can go ahead and spend $100 million to buy $50 million of Bitcoin, Ethereum, and various assets. Then that makes you the worst trader in the world, and you're a fucking idiot. You know what I mean? Like that's how it just go buy $100 million worth of Bitcoin and Ethereum. You don't need to spend all the money, time, and effort to and the months that it would take to attack THORChain to walk away with far less money. That would be wildly silly and wildly dumb. So it's really kind of important that THORChain has its own unique asset to ensure that people always lose the more value than they ever gain.
And so I guess the common counter argument there is, okay, well, what if I shorted it on the other side and like tried to make the profit on that point?
Fair questions. We actually literally talk about this in the economic white paper, which you can read. We published that 2 years ago or 3 years ago, whatever the hell it was. So as long as THORChain is the primary market for the Rune token, this becomes completely impractical, right? If you get to a situation where most of the Rune trading is on, Coinbase or something like this, then you can run into that potential problem, right? Where someone can short the token and then collapse the network and then make a profit. But if the tail is basically wagging the dog, so the dog wagging the tail, like that's when you can get in that problem. But because there's so much incentive for people to trade on THORChain to provide Rune into this network as a bond or as an LP or whatever, there's not much drive to put it on other exchanges. All the incentive, all the demand centers are right on THORChain itself.
Right. And so talking a little more on the bond side of things, right? So if I'm a validator, I have to post a bond and then post a bond to a significant enough size that I'm then churned into the network. And is that churn process exactly why it would take a longer time to even generate the attack against the network?
Yeah, because so the network does what we call a churn every like 3 or 4-ish days, right? And what that means is it's kicking out a bunch of nodes. Usually it's because of they've been churned in for a long period of time, or they have a lot of slash points that they weren't operating their node very well or very efficiently. Maybe they didn't upgrade their version to the latest version. And there's a handful of things that could kind of trigger somebody to be kicked out. But usually at minimum, there's 3 that get churned out at any given time, or maybe even 5, depending on scenarios. And then new ones get churned in based upon their bond size. How larger bonds get chosen first over smaller bonds, in a sense. And so if you wanted to take, there's about, I think there's 86 or 88 nodes in the network today or something like this. And so if you wanted to get 2/3 majority of that, you have to get your nodes to churn in, and then they're eventually going to get churned right back out again. So they have to get them churned back in again. It would be a difficult process and a very expensive process, because not only would you have to get so many nodes churned in, but your nodes would have to be far higher bonded than everybody else's nodes in the network, which would just create an economic hurdle that would be expensive to get past.
Right, exactly. And then I guess even on the other side of things, like if you were to try to make the short on the other side, it wouldn't be necessarily feasible, because you'd have to borrow a token in order to short it, right? And so if the economic incentive is to have all this Rune in the network, then there isn't even enough Rune outside of the network to execute that trade. And I'm curious, so THORChain's a Cosmos chain that currently is not IBC enabled. does that play into any of the incentive, is like not wanting to bring that Rune outside of the network?
Yeah, I mean, there's been a lot of conversations about the value or risks that are involved with integrating with IBC. But that is theoretically one of them. Being able to beam your Rune to another chain, which can be shorted there, is I guess a potential risk. I don't want to consider it to be a huge risk. I still don't think there'll be enough Rune on that other Cosmos chain to actually create like a significant problem, to be honest with you. But I think IBC is, as a project, we needed to do cross-chain bridging, which is basically what IBC does, like in some sense. But we had a very different spec, a requirement list than what IBC was trying to accomplish. We wanted to be chain agnostic. We wanted to operate not just within the Cosmos realm of things. We wanted to be able to connect with basically any chain in the world, right? With very little requirements to be being placed on those chains to be able to interact with them. And so, like, we wanted to support Bitcoin. We wanted to support Ethereum. We want to support I don't know, AVAX and maybe Solana and like other things, because we want something much more powerful and flexible than what IBC is really capable of doing.
Right. That makes sense. And then, recently on Twitter over the past day or two, there's been some Anatoly, the founder of Solana, has kind of been making this argument against the security of THORChain. And actually, he is open that it's not against the economic model. It's more on like the technology side of things. And I'd love for you to kind of like explain that argument a little bit, because to be honest, it's like very much in developer speak, and I'd love you to like distill that down for us a little bit.
Yeah, I mean, Anatoly is an interesting dude, and I certainly have a lot of respect for what he's trying to do. So I'm not trying to throw any shade at Anatoly or at Solana or any of these things. But what he's really talking about is something called RCE, which is like remote code execution. And so that's just like a fancy way of saying some malicious hacker, breaks into, a validator's node and then gains root access to it, like owns that server or whatever. That's like hypothetically what he's talking about. And to be fair, he's absolutely right. Like, if a vast majority, of 2/3 majority of the validators of THORChain's validator set were broken into, right? Some hacker got in through some, exploit or some 0-day thing, blah, 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 whatever it might be, and then own that node, then that person would have the ability to steal the Bitcoin and steal all the Ethereum and steal those assets. But that's true with like every computer system on the fucking planet as well. Like every single one of them. It's like, hey, if I break into all the computers and then I own it, and I'm like, well, yeah, if I break into somebody's house, then I own it too. Like, you know what I mean? It's like, I get what you're saying and you're right, but like, I can break into 2/3 majority. Not that I actually could or would, but like, I can break into 2/3 majority of Solana's nodes and then own it, or Osmosis, or Bitcoin, or like enter any like FBI's databases. Like, literally, like everything in the world works this way of like, hey, if you break into it, then you own it. It's like, well, yeah, that's literally how everything works. So it's not really like, to me, it's not anything specific about THORChain's design or implementation. It's just like a general thing about computers are not secure if you break into them. And I'm just like, that's true. I don't have anything to say. I don't have anything to say about that. It's just the reality of how computers work. Okay, thumbs up.
Yeah, yeah. No, that makes sense. I guess like the one thing to me is like, okay, so let's say I took all 2/3 of Solana nodes, control the network. You still can't sign transactions that move funds out of users' wallets. And like the one caveat with THORChain is they are securing these vaults that sit on the other networks that I guess theoretically could be drained if you did control the validators. But at that point, in my mind, it's like, okay, well, broken is broken.
Well, you don't, if you own 2/3 majority of the validator set, you don't need signatures to move funds. Because you own the network. You can just literally just push an update that moves funds from your wallet to my wallet. I don't require a signature from you to be able to move those funds. I can still move those funds, right? And then on the Bitcoin case, because we have external assets that are not controlled by not like signed by THORChain itself, like it's signed on the Bitcoin blockchain, you need to develop an actual signature to move those things. And if you have 2/3 majority of the network, you can generate that signature and move those funds. There really isn't much of a difference between THORChain and Solana in the sense, like, if you get 2/3 majority of the nodes on either case, you can move any funds you want to any location without any problems. The difference is, though, to be fair, to be objective and to be fair, is that because THORChain has I think 4 or 5 Asgard vaults at like 4 or 5 different threshold signature vaults, you'd only actually require to break into, I think, 14 nodes that run the same Asgard vault to steal those particular funds. So you wouldn't necessarily need a 2/3 majority to be able to steal funds. You would need to get through 14 nodes, which is different than Solana's case. But again, Solana doesn't do what we do. They don't have the same like requirements. They don't have the same challenges that we have. And so we have a different set of things that we have to worry about. So you can still move funds around even if you get 2/3 majority. You don't require signatures. His argument that like, oh, full nodes won't believe it. I'm like, well, full nodes don't matter. They're just like read replicas of all the data. Like they don't really matter. The state is made by the validator set. Like that's the only thing that really actually matters. If I want to move like SOL tokens from one wallet to another and I have 2/3 majority, I can just do that without really needing a signature.
Right. This is probably a good segue actually into one of my next questions, which is, okay, so THORChain supports a wide variety of assets today. You know, we have Bitcoin, Ethereum, and down the chain recently adding the Atom token to kind of like really break into that Cosmos side of things. And I'm just, so like, can you just walk us through like, okay, what's the process of adding a new chain? Like what needs to be done? And what are some limitations to some chains? And this is a good segue because, right, Solana is like one that maybe the barrier entry to get Solana into the ecosystem is a little bit too high.
Yeah, so there's a handful of things, and there's docs. I think it's like dev.thorchain.com or .org or something like this, where we document this process. But the first thing you gotta do is you gotta create what's called a chain client, which is the thing that basically observes transactions and signs transactions on that new chain. Let's just call it Solana for this purpose, right? Then we have to create like smoke tests, which is basically a way of like making sure that all the code works and everything can spin up and work and swap and add liquidity, withdraw liquidity, all the basics, right? All that kind of works. And then the next part is adding to what's called Xchain.js, which is a JavaScript library that just makes it really easy for web UIs just to like add Solana like overnight without needing to, rebuild the code over and over and over again. And then the fourth part is just like marketing process, like getting the THORChain community and getting the Solana community to come together and inform each other of each other's projects and what the value proposition is, blah, 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 these kind of things, so that we launch Solana with like liquidity, with people actually providing liquidity to the network, which would be obviously very positive. In terms of requirements, though, like technical requirements, it's very, very minimal. The only one the only one I can think of is like off the top of my head is like, can we generate private keys at random? Can I just generate my own wallet whenever I want to? Like that's a requirement. Like every blockchain supports that, for example. We ran into some problems with like, we were looking into doing like the secret network on the Cosmos chain. But they have like specific hardware requirements. They require XGX like chipsets to function. And so that creates too much of a technical barrier for our validators to be able to run a full node of the secret network, unfortunately. Solana is a problem because, as you were saying, it's very expensive. It's like probably like $2,000 or $3,000 on Amazon to run a Solana node. And that really cuts into the revenue that the validators are earning. Like they have operational costs, and the more nodes, the more chains we add, the more operational costs they have to endure. And then we have to make sure that the profit, the yield that they generate, is a good margin higher than the cost to operate it, right? And so that's the challenge with Solana, is because they're so expensive. It's like, well, is the network going to generate enough revenue from Solana to warrant the high cost that it would cost the validators to actually run the node? Is enough swaps going to happen? Is enough liquidity going to happen? Is there going to be enough? Is Anatoly going to be like, tweeting about it and telling people they should provide liquidity into THORChain or not? Like that actually becomes one of the things to consider. But in the end, like it's the network itself, it's the validators themselves that dictate whether or not we add new chains or don't add new chains. It's up to them. They make the choices, not me, not anybody else. So it's only the community that can make the final determination of whether or not we add Solana or not.
Has there been any signaling done towards kind of like which assets are next? And I'm super curious about if ETH L2s are kind of on that list.
Yes, I think probably the most likely chain to get added next would be probably Binance Smart Chain. It's just like obviously this mega huge economic powerhouse, and hopefully there's some good like value there, good like capital value there. L2s are totally possible, right? Both on the Lightning Network is possible. Polygon is possible. Like all these things. Like technically, it's kind of comical to think about it, but like technically validators could use like a Google spreadsheet as a data source if they really, really wanted to. I mean, you wouldn't do that because that would be insecure, blah, 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 all these things. But like, it can literally connect to anything, right? It doesn't have to be even a blockchain, technically speaking. But yeah, they can do L2s. That's something that people have talked about in the past, and there's definitely some interest in there. And it's a hotly debated topic of what is the next chain? Is it this? Is it that? Is it, who knows? And so my thinking is that Binance Smart Chain will probably be the next one. And I'm hoping that Monero will be the next one after that, because Monero would be huge for the industry. To be able to get in and out of Monero in a decentralized way without being KYC'd is, to me, that's a game changer.
Do you believe that like adding some of these privacy chains increases the likelihood that it bring on like regulatory risks at all?
For sure it does. The act of adding Monero, it wouldn't, or Zcash. It's not so much the act of adding it, it's more of the use of it. So like if North Korea started to push through $6 billion through THORChain, siphoning things through Monero, then I think that would trigger, government to get more involved in that sense. But at the same time, like I don't really try to think too much about what, the meat space is going to be doing and how X person or Y government would like it or wouldn't like it. It's more about what is right for humanity, right? Like what is like down to the core beliefs as our industry is about having, self-sovereignty and the freedom of decentralized frameworks and public good networks to achieve whatever it is you're trying to achieve in your life financially or whatever. I don't want to. I think it's morally right to grant the freedom to be able to trade privacy assets if you want. I think that's just we have the moral high ground in that regard, and that the right to access to privacy exists prior to government. Before the government even gets minted and even existed, the right to privacy already existed prior to them, and so they don't really have the right to remove my sense of privacy or anybody's sense of privacy in my view. So maybe that will happen, and maybe it won't. But if we're, if we're decentralized enough, it won't really matter so much.
Yeah, I definitely agree with the ethos there. And I'm curious. So if you were, let's say Monero's been on the chain and now all of a sudden, like becomes, for whatever reason, just imagine it becomes obvious that North Korea is doing exactly that. Do node operators have the ability to turn off the integration with Monero at that point?
Yeah, node operators have the ability to enable or disable what the hell they want. We've only disabled one chain so far, and that was Terra, for obvious reasons. But yeah, we have the ability to do that. And if the community really wanted to, they could even blacklist specific addresses. I don't think we should do that personally, and I would advocate against it. But if somebody wanted to do that, there's nothing to stop them if the community saw fit. Right, so it's up to the community. The community can literally do whatever the hell they want with this thing, whether or not I personally agree with it or not. So if they wanted to take off Monero or something, then they could. But more than likely, to be honest with you, the Monero pool probably would not be deep enough to warrant $6 billion trade of North Korean funneling of money, most likely. But maybe I'm wrong about that.
If you can't tell, we love data here at Blockworks Research, and Chainalysis, the leading blockchain analytics company, shares this passion with us. We use data to extract alpha and find the next thing coming in DeFi, but Chainalysis is doing the gritty work and building trust in blockchains. To onboard the next $1 trillion of capital into the industry, we need to grow safe consumer access to cryptocurrency and promote more financial freedom with less risk.
Chainalysis has some of the most comprehensive and reliable data in the space, and they use this data to power a full suite of their solutions that can be utilized by industry professionals. Best-in-class training and certifications are also led by Chainalysis and some of the brightest minds in the space. If you haven't heard of Chainalysis, you got to check them out, and we'll link to them in the show notes. On the same topic as liquidity, it seems to me, and correct me if I'm wrong, I could easily be wrong here, but the security of the network kind of increases alongside TVL. Do I kind of have that right?
It can. So if the dollar price of Rune, if the price of Rune goes up, then that would actually trigger both the security and the TVL to increase, right? If the TVL is just increasing on its own, it probably would not cause. Well, it wouldn't. So there's no direct cause of security to increase, but there's an indirect cause of, hey, people are LPing more, creating more buy pressure in the Rune asset, which causes the Rune value to go up, which causes security to go up. At the same time, as more TVL is added, and a greater percentage of the value is being added to the TVL side, the incentive pendulum kicks in, which kind of swings some of the yield away from the LPs and towards the nodes. And as the security increases, the pendulum swings towards the TVL, the pools, right? And so there's a natural incentive that pushes the yield towards the player that we want to become more active, and away from the person we want to become less active, depending upon just the free market of that moment.
Okay, I see. So that was going to be my question. I was going to ask, how do you exactly incentivize liquidity? But it sounds like that's kind of exactly how you do it. So perfect.
Yeah, the pendulum does it. So if the pools were like 100% full, like they were equal size to the security, then the pools would earn 0% APY, and the nodes would earn 100% of whatever the income was that the network is then generating. So that incentivizes node operators to like, oh, hey, I'm making massive yield here. Like I'm getting all of the yield of the entire system to my wallet, whatever. Let's buy some more Rune and add more Rune into the bond side and make more money. And meanwhile, the pool guys, the LPs are basically like, I'm earning 0% yield in this thing. What am I doing here? And then I'm just going to start to leave. And then that naturally creates that pendulum that pushes back towards a 2/3, 1/3 that we try to push for.
And the whole design behind that 2/3, 1/3, right, is so that if I'm a validator, if I were to say, okay, I control some portion of these assets on these networks. Like if I was going to steal these assets or act maliciously towards these assets, I would essentially be risking $2 for every $1 I could steal. Correct?
Yes, basically, yeah.
Yeah, so that kind of ties back to how the whole network really is like this economic incentives-based system with the goal of creating like a trustless model, right? To be able to just swap asset A into asset B through the THORChain network.
Right.
And that kind of that gets me into some of the more exciting recent developments, right? So we just launched the THORChain Savers Vaults. I've been watching the synth utilization there like a hawk, and it looks like the Bitcoin one maxed out, in like less than a month. That? Maybe even like 2 weeks. So I'd love to get a little background on what exactly the Savers Vaults are and kind of how they work.
Yeah, so when we launched the network, we launched with just as a regular AMM, and we made some significant advancements. Like we don't have MEV attacks, for example. We use slip-based fee model, which is much more efficient and effective way to charge fees, for example. We made a lot of significant advancements in AMMs when we launched this thing. But the problem we ran into, I think, as a community is that if you think about like a Venn diagram, right, and there's like two circles and then like a little sliver between the two of them. One of those circles is like people who want to earn Rune on their Rune, and another circle is people who want to earn Bitcoin on their Bitcoin. And there's some people, that little sliver in the middle, that want to earn both, right? And that's basically what a dual LP is, that little sliver in the middle, right, in a matter of speaking. And so we were talking to a bunch of we were offering like Bitcoin yield, for example, and we were talking to a bunch of these Bitcoin whales who were like, hey, come, provide your Bitcoin into the Bitcoin pool and earn yield. But then they'd say to us like, well, I don't want to sell half my Bitcoin into Rune and then take on that price exposure of the Rune asset. Like, I don't want to do that. I'm a Bitcoin person. I'm a Bitcoin, maybe I'm a maxi or whatever it might be, right? And so we had a hard time like convincing those types of people to like provide liquidity to get our pools super deep. And so then we came up with this idea of like how to do single-sided yield, like that you provide Bitcoin, you get Bitcoin as your yield, and you're not price exposed to the Rune asset at all. You're just price exposed to just Bitcoin. And we came up with this design, this Savers design that we now launched a few weeks ago. And so it's going to be our solution to this problem. Like, how do we scale the liquidity in the network by offering something that nobody else in DeFi land can offer, and only centralized services offer, like BlockFi, for example. But then again, they don't offer it anymore either because they don't exist anymore. they're now 6 feet under, in a matter of speaking. So now, like, in a sense, like the only place you can actually get Bitcoin yield in your Bitcoin is basically two places. One is mining Bitcoin, in a sense, and the other one is here on THORChain, right, where we offer like I think a 5% APY.
And so if we talk about where that revenue comes from, right? So you're essentially just a single-sided LP in this scenario, right? Like you only have price exposure to one asset in the pool. Where does the revenue come from?
Well, it comes from the pool itself, right? So like the pool is generating yield from swaps and trades. It's also generating yield from just from block rewards, just like Bitcoin does. And so all that's being put into the pools, and that generates some amount of yield. And then you get some percentage of that yield depending upon how many savers you have in the network.
The Savers vaults are essentially built on top of a previous THORChain primitive called synthetic assets. Can you kind of dive into what a synth is and how it's always secured to be, or how it's always redeemable for 1-to-1 for the underlying asset, and kind of like what that backing is?
Yeah. So what backs the collateral of a synthetic asset is the pool itself. The Bitcoin pool backs the synthetic Bitcoin assets, and so it's backed half by Bitcoin and half by Rune. So it's led by the pool itself. And so whenever you're trading from synthetic Bitcoin to like layer 1 Bitcoin, you're basically making a swap or a trade to the layer 1 asset, and then you leave with your layer 1 Bitcoin, right? So the more synths that we have in the network, the more of a percentage the synths own of that pool, in a sense. And as the synths grow in value because Bitcoin's price goes up by relative to Rune, it just kind of siphons some value from the LPs to make sure we've got this value, this purchasing power required for all the synths is like put aside and locked away for them to prove that they have the value they needed to support their synthetic assets.
Right. And so essentially then, like, if I am a vault saver, and let's keep using Bitcoin, for example. Like, I'd say I have, one native Bitcoin and I want to earn yield on this. Can you just walk me through the process of both what I experience as a vault saver, so like the actual process of me joining the vault, and then what that looks like to me versus what that looks like to the protocol?
Yeah. So to you, it's like super clean, super simple. You can't get anything dumber than this. You literally just send some Bitcoin to an address. You just transfer Bitcoin. That's all you do. That's it. You're done. Nothing more. And then when you want to take your Bitcoin out later, you just send some dust at the network saying, which basically the dust communicates like, I want to withdraw my Bitcoin, and the network just sends you your Bitcoin. So for you, it's just like super clean, super simple. You can literally do this from any Bitcoin wallet in the world. Doesn't matter. They all support it, right? From the network's perspective, it's doing something much more complicated. It's abstracting all that complexity away for you. So it's receiving your Bitcoin, right? And then it's contributing that Bitcoin and its value into the pool, and then it's minting a synthetic Bitcoin, like a one synthetic Bitcoin for your trade here. There's a swap fee that's happening when you're entering this position, so you do get charged some small fee for that. But you basically are taking your one Bitcoin, put it in the network, and the Bitcoin gets added to the pool, and then it mints a synthetic Bitcoin, so it gives you the claim on that liquidity in the pool to be equal to one Bitcoin. So no matter what happens to the Bitcoin price, it has that claim that like one Bitcoin worth of purchasing power, or just like one Bitcoin is available to you, right? And so while the network is there and it's producing yield from the swaps and the block rewards, blah blah blah, all these things, the network will just mint new synthetic Bitcoin into the Savers vault, right? Which basically just reallocates value from the LPs to the Savers. It's like basically like the LPs getting like all the yield. And then at the end of the block, the network just says, okay, you got, $100, but 20 of that dollars should go to the Bitcoin Savers people. So we're going to mint basically $20 worth, which basically just transfers value from the LPs to the Savers. It's another way of like an easy way of mathematically achieving that goal. And so while that's just generating all that revenue, you can sit there for as long as you want or as much Bitcoin as you want, whatever. Right now it's like 5% of PY. And then when you're ready, the reverse happens when you withdraw. You just send some Bitcoin dust at the network saying, this would just be making a request to withdraw all your Bitcoin. It takes whatever amount of Bitcoin that you put in plus whatever you generated at that $20, we'll just say, or whatever it might be, and then makes a swap from synthetic Bitcoin back to layer 1 Bitcoin, which there are swap fees that are charged for that purpose. And then you receive your Bitcoin on the other side. You do this whole thing from just a Bitcoin wallet. You never actually got a Thor wallet. You never really got Rune. Didn't need to touch it, hold it, whatever. All happens just from signing transactions on the Bitcoin network.
This is really exciting to me because, like from the first day I got into crypto, I was like, this stuff is so cool. But it's interesting to me because like I love just like the technical side of things. I love the economic side of things. But I'm like, for mass adoption to happen, we need to simplify the shit out of this.
Yes.
And that's exactly what THORChain is doing. It's like obfuscating that insane complicated process away with literally just sending one transaction. And to me, that's what like really gets me excited about this.
Yeah, that was one of our concerns about being an LP and an AMM. It's like a complicated concept because you have to make multiple assets, and then you're price exposed to multiple assets, which means you have impermanent loss issues, which can make it really conflated or hard to understand. Like, are you up? Are you down? Like, how are you performing? And you're like, it's just a really difficult thing to understand. And so that's why we're kind of shifting in some sense. Like at least some of the devs are like, let's move away from like traditional LPs and providing both sides, and just move towards savers as the avenue for most people to provide liquidity, because it's so clean. There's no impermanent loss to worry about. It's just like, I put in Bitcoin, and then tomorrow I have more Bitcoin, and the next day I have more Bitcoin, and the next day I have more Bitcoin. There's no fluctuating yield in the sense of like, oh, I'm up $10, I'm down $30, I'm up $30, I'm down $30. Like, it's just like, it literally only goes in one direction. You're just earning more yield every day, and it just goes in a single direction, which is just so easy to understand and easy to follow, right? So I think that's where I think we're heading as a community, is that we're going to moving away from LPs, allowing what we call protocol-owned liquidity to kind of take on that role, and then just allow everybody just to provide Bitcoin to the network and whatever asset they want, and just make the pool super deep.
Yeah, that actually leads me into a question I had. I know you guys had IL protection, like after like 100 days of providing liquidity. Is that still a thing? Is that something you think should stay a thing in the future? What are your thoughts there?
Yeah, so the idea of IL protection was just like, in the earliest days of THORChain, we wanted to remove as many like arguments or reasons why you would not want to LP on the network, right? And impermanent losses is one of those like risks you take on as a dual-sided LP in any AMM in the world, except for Curve, because everything is the same price. So we added that to incentivize, and then the reality was, as we did the math after looking at like I think 6 to 12 months of economic data from the network from single chain chaos net, was that like after 100 days people don't experience permanent loss. It's like, it's very low risk, right? Because they generate so many fees during those 100 days that whatever IL you're experiencing is not going to be greater than the actual fees that you generated, the yield that you generated. And so we added it in part because it's like, not because it actually did anything, it just gave people a sense of comfort. But in reality, it really doesn't actually really do all that much. It doesn't actually, the network doesn't require that much IL protection, to be honest with you, right? I think in total it's paid maybe about like 3 million Rune in total out of $10 billion in transaction volume, and 80 million Rune in bond, and I think like 30 or 40 million, and like it's a very relatively small percentage of that. So I think that there's now a debate to remove ILP. The reason why that is because we didn't have a method for people to get a yield on THORChain without being exposed to IL, but now we do with savers, right? So if you're risk adverse and you just want to get Bitcoin, you want to get like less yield but less risk, blah blah blah, then this is your thing for you. Jump into Bitcoin savers, right? But if you are risk on and you want a higher risk but higher reward system, then being a dual-sided LP is probably right for you, right? And so we don't need to come up with this crux to convince people to be an ILP, to be a LP anymore, because we have another option for them that works effectively pretty well, right? So I think my intention or my interest or I advocate for is just to remove ILP with grandfathering in people who are already LPs before. Like they've already got the ILP, like we've already guaranteed their ILP. We don't want to strip something away from somebody who has already given it. So grandfather in everybody who's like already an LP, and then new LPs into the future would not have access to that ILP.
Right, and that kind of is a good segue into the next point here. So, you talk about how there's essentially now two LPs within the pool, right? The traditional two-sided, double-sided LPs, as well as the savers who just have that single-sided exposure. And that kind of changes the risk profile of the presence of synths, or the presence of savers as well, right? Changes the risk profile of those double-sided LPs. Can you talk a little bit about how exactly that changes and sort of how synth caps play into this?
Yeah, so think about it this way, like the network has, let's see how to put this in a simple way. As an LP, you are in some sense backing the value of the synths, right? Like as a synth receiver, as somebody who has a synth, you provided one Bitcoin and the network gave you one synthetic Bitcoin minus swap fees, right? And if the Bitcoin price moves relative to Rune in one direction or the other, that is either giving value to LPs or taking away value from LPs. So if Bitcoin is outperforming Rune, then we need to take value from LPs to ensure that the synth holders are whole and that we maintain the value of their synthetic asset. If Rune outperforms Bitcoin, then we basically take value from the synth people and we give it to the LPs, right? And so in a sense, like you can look at it as a dual-sided LP is like, again, a slightly leveraged Rune position, right? In some sense, like you're getting either more yield or less yield depending upon Rune's performance, right? And how much leverage there is relative to the synth utilization of that pool. So if synths are like 1%, there's like basically almost no leverage. It's basically the same thing as if there was 0, right? It's because it's so close to each other. If there was 90% synths and 10% LPs, well, then it's like highly leveraged, right? I don't know what X leverage it would be, but like you'd be, if Rune's price performs well relative to asset, you would gain a lot of money really fast. And then of course, in the reverse direction, you would lose a lot of money really, really fast. And so if you're taking on like a leveraged position with the Rune asset versus the other asset, and the more synths there are, the more risk there is for LPs in a sense. The more leverage there is for the LPs, I should say.
So taking on the skeptic's view here, Rune itself it's an altcoin that tends to move about 2x the change in Bitcoin in a given day, right? So if Bitcoin moves 5%, Rune's probably 7 to 10% up, and the vice versa is true as well, right? If Bitcoin's down, Rune's down more. So taking on a leverage bet on an altcoin such as Rune, right? Like that would make some people nervous, and because the immediate thought is, okay, what's worst case scenario is like, let's say, for whatever reason, Rune crashes 75% over the course of a week. How would that affect the pools and the LPs within that pool?
Yeah, if that were to happen, hypothetically, the LPs would have more loss in their position, right? Some of their principal might have been eaten up in some sense. But not realized. It's not realized until people actually leave, right? Since either leave or you leave yourself. So it's an unrealized loss or unrealized income, depending on which direction we're going. I think like one of the things that I'm kind of fascinated by is that we just kind of like allow dual-sided LPs to become as risky as they want, right? To like some high synth utilization, and then allow the POL to be the LP of last resort. And so, like maybe into the future, it's like there's not even really any dual-sided LPs anymore, except for people who are like really bullish Rune and they want to take this huge like leverage position or whatever. And it's just like the POL and savers, and that's all there is. And if that's what it is, then it's like a super clean, simple thing. Like there's not a bunch of different products for people to worry about. It's just like you just get in with savers and you get your income, and then you walk away, and then everything else is just like abstracted away by the protocol itself. Because the protocol can be bullish Rune. Like obviously the network itself is very bullish its own asset for obvious reasons. And it has a very long time view to look at it. Like it doesn't really care about, bull markets and bear markets. It's looking on like multi-year, multi-decade perspective, right? It's a much longer range viewpoint than your average retail investor. So it has no problem taking on, bull markets and bear markets because the network feels over the long term, Rune will, outperform Bitcoin just over at any given time over the long term of the network of a decade, for example.
So the synth caps today are 30% of the asset depth in the pool, right? So if there's 100 Bitcoin, there can be 30 synths minted, synthetic Bitcoin minted. How do you feel about pushing that number higher? Is there a number that makes sense, and does that change when protocol-owned liquidity becomes active?
Yes. So. Like I mentioned before, the higher that synth utilization is, the more leveraged position the LPs would be taking, right? And you really can't. I mean, you could, but you don't really want to enable the POL to start providing liquidity to these pools below 50% utilization. The reason why that is because if somebody jumps in with $1 of savings, then the POL has to dump in $2 of Rune to counteract that, which means there's $1 of buy pressure and $2 of sell pressure on the Rune asset, which obviously we don't like that. right? At 50%, it's a 1-to-1. It's like a $1 buy pressure, $1 sell pressure, and it's just like they just cancel each other out. If you go further beyond that, you go to like 70% centralization or 80% or higher. Now it's like a 2-to-1 or a 3-to-1 and buy pressure on the Rune asset versus the sell pressure, right? So that's like basically how the math works from a high level, right? So, but once you put it at, let's say we put the POL at 50% utilization, that means that savers can basically scale as high as it wants to, all right? Because as more savers enters, POL adds, basically an equivalent amount of value on the other side, meaning the synth utilization stays constant at 50%. Even if you keep on adding more synths, the synth utilization will still stay constant at 50% because the POL is kind of adding the other side of it, right? In a matter of speaking. You can do this forever until you get to the point where you hit the hard caps of the network, the security of the network, right? Which is some number. But like the POL will allow the synths to scale as far high as they would like to up until that hard cap.
Right. And so if synths are 50% of the pool, and synths are effectively liabilities underwritten by the pool or the LPs in the pool, is there a price change where there becomes a point where like the pool is effectively like insolvent, if you will? That might not be the right word, but where the value of the synths outweighs the value that they should be redeemable for?
Yeah, so hypothetically, if you were to see a 4x, if it's at 50% synth utilization, and you were to see a 4x price change in Rune's value down or assets value up, doesn't matter which direction, or 2x down and 2x up, depending on whatever. At that point, you would see that the synth value and the pool value would be the same, right? Which basically means all the LPs have zero value and the synths have all of the value, and so the synths are happy. They're still happy. They have still their value. But the LPs have been more or less an unrealized wiped out in some sense, right? That's the theoretical thing. Now, what would actually happen in that scenario is that the POL would just start pumping more value into the pools, and by doing so, LPs start regaining their value back, right? So the POL is, in some sense, a bodyguard to the LPs. That like as they experience losses, the POL jumps in front of them in a sense and says, "I'll take some of that losses myself," and to support the LPs. But even if they left at that point where they were zero, impermanent loss protection is still there unless it's been turned off on them. But like that would be the backstop. So in the end, it's not even really LPs who are backstopping the value of the savers. It's really in the end, it's going to be the reserve, which is like 170 million, which is I think like 40-something% of the circulating of the supply of Rune itself, right? But like even if it goes, this is kind of a fascinating thing. Like even if it goes beyond that, say instead of a 4x price change, we saw a 6x price change, right? Now we're like really bad, right? Now the value of the synths is greater than the value of the pool, right? And you might say to yourself, "Holy shit, we're insolvent. We have all these problems. The world's going to end, blah, blah, blah." Reality, it doesn't actually matter, as counterintuitive as that might sound, because the network will still redeem your synthetic Bitcoin for 1 Bitcoin, right? So as you start leaving the network and saying, "Oh, my synthetic Bitcoin, I'm going to get back my layer 1 Bitcoin and leave," you're still getting a 1-to-1 relationship. The asset has not depegged in this scenario, right? Everything is still fine in that regard. And as you start to leave, you push the network back towards quote unquote solvency, even though it's never actually insolvent, because the reserve is always there to provide whatever capital. It is the LP of last resort. So as long as there's enough value in the reserve, than the synth value, then we have nothing to worry about. Even if in the pool, the synth's worth more than the pool, that actually doesn't even really matter. In the end, it's not the pool that matters, it's the reserve that matters. And the reserve is always going to have far more than the pools because the reserve is capped, the pools are capped by the security of the network, which is like 80 million Rune right now. So you can't get to a situation where the pools are like 200 million in depth or whatever. Mathematically, it's literally impossible. So it'd be very difficult for the reserve to run out of money in that scenario.
Right on. Okay, so that makes sense. So effectively, like let's say like the Rune asset price crashed 4x relative to Bitcoin. Like as that crash was happening, the protocol owned liquidity would be chipping in liquidity, essentially keeping that synth utilization percentage right at 50%. So like every time it rose to 51%, fall back down to 50%. Does that make sense? Do I have that right?
Yep. Exactly.
Awesome. And you've been so gracious with your time. And so I do want to be respectful of that. But I do want to just quickly touch on THORFi Lending. Like, is that still something that the network wants to roll out? And if you could kind of give like just a little intro overview of what that really is.
Yes. So we have this idea for this lending design that is very innovative and it's very experimental. It's structurally very different than everything else we've seen in the DeFi space. But because it's structured so differently, it allows us to do things that nobody else can, right? Beyond just like the idea that we are an asset agnostic or chain agnostic DeFi protocol. So whatever services we launch, whether it be savers or lending or whatever, it's applicable to any asset on basically any chain, more or less, right? So the fact that it supports like layer 1 Bitcoin loans, that by itself is pretty gargantuan. Like that's a pretty major advancement in DeFi that we can actually support layer 1 Bitcoin loans. But we didn't just leave it at that because that would be too easy. We went a little further and we designed something structurally so different than everything else we've seen before that allows us to do a loan that is 0% interest, so you pay no interest on it. It has no liquidations, so even if your collateral drops below the value of your debt, you do not get liquidated. You can still collect your collateral at any time that you want to, right? Which is pretty amazing to think about. And then also it has no expirations as well. You don't have to pay it back within a week or a month or 6 months. Pay it back in 30 years. I don't really give a shit. It's all fine. So like it's a lending design that is unlike anything we've seen in DeFi and anything we've seen in CeFi/TradFi. Like this doesn't exist in TradFi either because it's not profitable for them because they're a company, they're a private entity, they want to make a lot of money. This is a public good network. It's a little bit different. And so we can do things that nobody else can structurally do, which is really kind of empowering. And so this allows people to take out actual loans with their crypto and be able to live on that crypto, be able to buy things like coffee and houses and whatever else you want to try not to do. Meanwhile, not needing to like be up all night long looking at your DeFi loan that's like about to get liquidated and you're not really sure and you're stressing the fuck out about it. Or the interest rate, is inflating all over the place. It's like it's fluctuating like crazy to like 10, 20, 30, 40%, whatever the hell it is. And you're just paying these massive interest rates on something that like, oh crap, like I'm getting totally screwed here. Like those loans aren't really effective at doing what they do. Like they're great if you want to like, leverage up your position and do some degen kind of style things. But if you actually wanted a loan to like buy a house, like DeFi loans are terrible for that because they're so stressful to have. And like, what if you don't have more Ethereum to pump into your collateral? Then you lose all your collateral, then you get completely zeroed, and then you're just like, fuck me, this sucks, right? And that happens to people all the time. Like it happened to people with Terra, it happened with people with like every lending platform that you can think of. But here it's so different. Like you always get your collateral back, and that's really kind of revolutionary.
Do you see THORChain, like you guys are clearly building products that are like really user friendly, like actual use cases for real people. Do you think that THORChain will be like the backend infrastructure and user interfaces will be built on top, kind of like XDeFi wallet, or do you think that THORChain will build that out into the future?
I hope the former because I don't want to be building that out. I want other projects and other people to be building it out. I don't think it's really needed for me to do it. I know that people are building great UIs around it, like DeFi Spots One, XDeFi, THORSwap, Thor Wallet, and there's tons of them. And even like the Savers product, like I know somebody who's building a UI just to allow any Bitcoin wallet to deploy. Like it's gonna be bitcoinsavers.com or some website. I don't even know what the domain's gonna be, but like they just basically have a QR code that you generates on the site, and you just like, oh, that's you take your phone or whatever, or your ledger or whatever, and you just like input your transaction information and Bob's your uncle, right? Like it's going to be so clean and so simple that like hopefully THORChain just kind of fades away into the background, and most people using it have no idea it even exists, right? That's part of the goal. Like with DEX aggregation I was talking about earlier, but people are just swapping between different chains, different assets. They don't know they're touching THORChain. All they know they're using Uniswap's UI to get some Bitcoin, but they don't know that THORChain is powering that entire system, right? And Trust Wallet just launched their integration the other day. People are going to Trust Wallet and they're swapping Bitcoin for Ethereum, for example. They have no idea that THORChain is powering that entire thing, but it is, right? And so like THORChain just become this like critical pillar of infrastructure that exists for the entire cryptocurrency space that nobody even knows exists. It's gonna be insane.
Yeah, that's super exciting. I can't wait to watch how it all plays out. But thank you so much for coming on, Chad. We'll let you get to it. Do you want to like tell people where they can find you real quick?
I mean, you can find me on Twitter if you want to. I'm pretty boring though. There's the THORChain Twitter account, which you can follow that, and there's a group of people in the community. But like, yeah, just learn more, read more, ask questions, jump in our Discord. Right, the more you learn about this product and this protocol and what we're doing and how we're accomplishing these things, I think the more people are gonna love it.
Awesome, great. Well, we'll have you on again in the future, and thanks for coming on.
Thanks, Sam.